네, 1분기를 지금 돌아보기에는 조금 이른 감이 없잖아 있지만 잠시라도 돌아보면 굉장히 힘든 한 반기를 보내왔습니다. 우크라이나 사태로 유가가 급등하기도 했고요. 지금은 또 인플레이션 이슈가 전 세계 증시를 압박하고 있는 가운데 현재 이 불안함을 가지고 있는 뉴욕 증시 상황에 대해서 점검이 필요해 보이는데요. 지금 현재 미국에 계신 월가 트레이더 버니 씨의 이야기를 들어보도록 하겠습니다. 함께 보시죠.
We have so many things going on right now. We've got the Ukraine invasion by Russia. We've got the potential for our first interest rate increase this week by the Fed. So what we need to do, and we still see the market, basically all the rallies are accompanied by short-term rallies and then followed by price declines again. So what we're doing since the end of January is we're trading in a very choppy range. But what I want to talk about now is I want to monitor the progress of this decline and then compare the progress or look at it in perspective to other market declines. Because I think it's very important to understand how we're declining and where we're going to go. We've talked about before that there are global economic events that occur in terms of invasions, all that, that are actually buying opportunities for the market because 6 months, 9 months, 1 year out, the market's higher than that. We clearly have that going on in this time. It's very difficult to understand that we're going to do better because when you're in the middle of all this, it just doesn't look very good. So you're always thinking, what's the next worst thing that can happen? What's the next worst thing that can happen? And we certainly do feel for the people in Ukraine, and what's going on there is not really very fair at all. But we just want to think about it with respect to the markets. One of the things that I always think about is that at the top of the market, and the reason it's the top of the market is there's not anybody bullish. Everybody believes that the market's probably going to go higher. And at the bottom of the market, and it's very difficult to buy the bottom of the market because the bottom of the market is such that no one wants to be long. Otherwise, he wouldn't be going down like that. So there's an overwhelming capitulation at the bottom of the market. And it's very difficult to be able to bottom pick the bottom of the market. But we still want to monitor and put the decline that we have so far in perspective, because most likely I think there'll be a good rally in the second half of this year just because of the different things we've talked about before, whether we're talking about the second year of a presidential election, whether we're talking about the fact that we actually have these price declines right now, and we've taken some of the price to earnings premiums that we had in the ratios back down to some normality. Those are the things we want to think about. So the first chart right here looks at the declines off of the highs by the S&P 500, and this is looking since 2007. So when we're at the top line right here, what that means is the market made a new high, because that means there's no percentage move off the high. And then every time we go off the high, this number, the red line goes down. So we can see how deep the 2008 recession got the market down. It was down 55%. Now, what we've gone through between 2012 and current is that we've had a bunch of declines that basically have gone down somewhere between 5 and 10%, and the market keeps making new highs. In 2020, when we had COVID, we had a much more significant market decline. And now what we have right now is, as of this week, we were down about 12.8% on the S&P 500. So we can compare over the last almost 15 years how deep our decline is right now and how attractive prices are. Let's go to the next clip. Now, I did the same thing, and what we did is we went back all the way to 1989. So we're looking at the same thing, and now we can put, this is the dot-com bubble where the market really, the technology market sold off so much, and then we can see what happened in 2008, and now we can see how deep we've gone so far. And now it just puts us in perspective, because there's a lot of 5% declines, there's less but still pretty many 10% declines, there's less but some 15% declines, and then when we get to a 20% decline, there's just not that many of them. So we have to think about that. And I think that given the fact that the Fed is going to not be as restrictive as people thought, I think that we need to think about how deep this decline could be. Now, one thing that we've looked at, and this is the NASDAQ composite chart, and this line right here is the new highs and new lows. So either a market makes a new 52-week new low, and a market makes a new 52-week new high, and we compare that differences. So what we found was at the bottom of the market, that first capitulation in late January, 1,200 of the NASDAQ composite stocks, of which there are 2,500, made a new 52-week low that week. Okay, now we had a pretty significant bounce off that, and then we've gone down and made a new low. We've bounced up and we've gone down. But notice that we didn't make a new 52-week low in the new highs minus new lows. So why? Well, there's two possible answers to that question. The one is the quality stocks all made a new 52-week low here, and now even though the market's declining, fewer and fewer stocks are making new 52-week lows. Only the lesser quality stocks are making new 52-week lows now, and the bigger stocks are trying to hang in. Or the other thing could be we're just ready to roll over again, and we don't really know the answer to that yet. That's going to have to play out. But those are the two possibilities that we can look at currently. The biggest driver on the downside are technology stocks. They were also the biggest driver on the upside, and they have the most volatility of any sector that the S&P is comprised of. So what we want to look at right here now is that take a 200-day moving average of all the technology stocks, and how many of them are above that 200-day moving average, which is about 1 year's worth of data, and how many of them are below. And we can see they're almost 15% of the stocks are above that line. So that means 85% of the are below the average of where they've been over the last year. And that is totally understandable, but we really want to see how many of the stocks, not just how deep the index is declining, but of the composite, how many of the stocks are down, because the more the stocks that are down, the more attractive prices are overall. So let's go to the next clip. And what we want to do now is take the same analysis and think about 50-day moving average. And what we see now, obviously, is going to be much more volatility. And what we're seeing now is we're down to 9% of all the technology stocks are above their 50-day moving average. So over 90% are below their 50-day moving average. At that capitulation low that we saw at the end of January, we had only about 6% of the stocks were above their 50-day moving average. So 94% of all the stocks were below their 50-day moving average. I think what we want to do is we want to monitor this zone, but to me this zone is telling us that the technology sector is starting to get very, very cheap, relatively attractive relative to the index. And technology represents about 28% of the S&P 500 index. So it's a big component of it. It's a volatile component, and it's a big component.